A warm welcome to the Monday version of the On the Tape podcast. I'm Guy Adami. I'm always joined by EYT. Of course, that's Elizabeth Young Thomas of SoFi. EYT, how are you?
I am good. Happy Monday to both of you.
Stu as well. And Dan Nathan joining as well. Dan, busy weekend for you as you moved two children into Georgetown University. How'd that go?
Into your alma mater, Guy. It went well. It was a busy weekend, but everyone's happy and moved in. Beds are made, the whole like here. But, Guy, Friday afternoon, I missed this orgy of buying in the stock market. Your main man, Fed Chair Powell, had a few things to say out there in Jacksonville. Why can't he just do the things that other people do out there? A little river rafting, maybe some, fly fishing or something. But he's got to talk up. He's got to talk up markets and talk down rates.
It would appear that way. And, again, I'll say I'm not a big lover of the Federal Reserve or any central banks, but I've said this and I'll say it again. Although I'm not a fan, I do think he's done a very good job in terms of not negotiating, but verbalizing and basically messaging. And, the market's interpretation is what it is. He can't control that. But I think in terms of what he's done, Elizabeth, over the last, I don't know, call it 2.5 years or so, outside of a couple mishaps, couple sort of missteps, I think he's done a pretty reasonable job in terms of the messaging he's trying to get across.
I would absolutely agree with that. I think that what we want to see out of a Fed chair is that he learns from his mistakes. And he had that big snafu in 2018. I think he learned very well from that. And frankly, I think he doesn't like that he has to talk as often as he does. And he doesn't like that there's so much commentary out there from the Fed, but it's now the world we live in. So he told us on Friday that the time has come and he secured that September cut. The other thing that I really like about Jerome Powell is that he's got a sense of humor. He works jokes into his commentary. I think the best one this time was something along the lines of the good ship transitory was a crowded one. And now they've all kind of gotten off the ship. So here we are, we're embarking on a cutting cycle. And now the big question mark is just, will it be 25 or 50?
Yeah. And so, Dan, I mean, obviously this week it's going to be dominated by everybody talking about NVIDIA, and probably to a certain extent, rightly so. I mean, that is the main attraction. But there are other things going on this week as well, not least of which, obviously, on Friday, as we get what do they call that? The Fed's favored measure of inflation.
Yeah, I think why that's important right here is just kind of to Liz's point here. What is the pace of cuts going to look like? What is the data that is going to be driving these sorts of cuts? We know that inflation is one of the key components, and I'll just say this, Liz, going back to 2018, this is when guys started to gain some respect for Fed Chair Powell, because they basically said they wanted to normalize interest rates. They started raising 25 basis points, every meeting or every other meeting, that sort of thing. And it wasn't until the S&P sold off how much, Guy, in Q4 of 2018?
That would be 19.9% from Halloween until Christmas Eve.
Yeah, and you've made this point, Guy. I mean, he kind of got browbeat by the administration to stem what was, like a concerning sort of market sell-off based on not just what was going on over here, but growth scares, around the world, which is not too different than we have right now. We have this Pinduoduo, the ticker is PDD. It's a Chinese e-commerce company. They're the ones that own Temu. You remember Temu just blasting the airwaves here in the U.S. It's that kind of really low-end, retailer. Stock's down 25% right now because they missed, sales, and their outlook is poor in China. So what we have here is a situation where China, which is the engine or has been the engine of growth for decades for U.S. multinationals, it's losing it. It's gone. You know what I mean? And so to me, I think the situation here is like we are operating on a different level relative to all of the developed world, Europe in particular. And then when you look into emerging markets too, it makes those rate differentials, Liz, that much more challenging. You guys have spent a lot of time talking about the yen, a lot of time talking about the yuan, and just look at what's happened to the dollar here too, which is really interesting. It's made the Dixie made new 52-week lows on Friday afternoon.
Yeah. Okay. So there's two reasons why this is important. Maybe more than two reasons. First of all, the dollar falling is a new environment, and I think it's an environment that will persist, especially now that we know for sure we are about to start a cutting cycle. Because what happens is those interest rate differentials narrow, particularly with things like the Japanese yen. So we've got this falling dollar environment that is likely to persist through the end of the year, or at least through the time when the cutting cycle persists, with the only caveat being if there's fear that suddenly erupts around the world, usually the dollar catches a bid in that environment. But first and most important thing to think about is that in a falling dollar environment, what tends to do well? We talked about this a little bit last week. The sectors that tend to do well, what are the industry groups that tend to do well? The top two industry groups, you've got medical devices and you've got aerospace and defense. Those are different industry groups than what has been leading the market all the way up. And then, not to mention, when you've got certain rate environments, which is also what we're embarking on for this fall, you want to be in things like utilities, healthcare, staples, energy. So thinking about from an investor point of view, shifting your mindset off of big tech, off of communications, off of consumer discretionary, and looking at the sectors, making sure that you have an allocation to the sectors that typically do well in that environment. The other reason that this is very important as the dollar falls, gold. You keep seeing gold rise and rise and rise. And so many haters out there saying it can't keep going, it won't keep going up. Number one, I think gold has caught such a bid because there is a big risk of currency volatility, some of which we've already seen in the form of the Japanese yen. But as the dollar falls, people are looking for more and more stores of value, and still, I think, questioning whether or not crypto actually provides that. So gold and gold adjacent trades continue to do well, and I still think there's strength to be had there.
Yeah, I agree with that, and I'm going to opine a second in gold. But in terms of some of the things that we saw this week, and this plays into it earlier this morning, and this is again Monday morning as we're doing this. The market just opened. United States July durable goods came out. July durable good orders rose 9.9% month over month, which was basically double what the street was expecting. The street was at 5%. This is probably the highest we've seen since probably pre-COVID. But yet, services inflation and rent inflation are still north of 5% year over year on a pretty consistent basis. And that sort of dovetails to a tweet I saw earlier from CQ, Dan. That would be the great Carl Quintanilla, talking about Ed Yardeni. And Yardeni's tweet was Powell was, again, in quotes, unambiguously bullish for stocks. Quote again, furthermore, stronger than expected economic news is likely coming in weeks. Is likely in coming weeks. So we saw that in terms of the durable goods without question. His base case for the S&P 500 is 5,800 by the end of this year, 6,300 by the end of next year. And quite frankly, given that, I mean, it's very hard to argue as we're sitting here, Dan, with the S&P effectively at all-time highs.
Right now, it feels kind of as good as it gets, right? So if the data is supporting, you know what I mean, them to kind of do the mission accomplished. And I think that's very different than a few weeks ago on August 5th, all the screams, and we talked about this a lot, for, intermeeting emergency rate cuts because the economy was falling out of bed. And it feels like we're just so far away from that with stocks, really signaling a soft landing. And so to me, I just feel like there's universal, optimism that the Fed just landed the plane, which I just think is so interesting. And, listen, I want to go back to some of these sectors, Liz, that you're mentioning that do well in a soft landing environment, a rate cutting environment, a weak dollar environment. Last week we were talking about crude oil in the low 70s down from the low 80s, but here it is. It's kind of rallying a little bit on some of these Mideast tensions and what happened in Lebanon over the weekend. But when I think about these sectors, I mean, man, the staples, the XLP, I think you had a tweet about this, getting into overbought territory, the utilities just running away. And there might be some other things other than technical when you think about all the power demand for Gen AI. That's been a story that we've been hearing about. But Liz, how do you rotate into these sectors with the S&P at all-time highs, right? And it feels like people were positioned for this anyway.
I think people were a little positioned for it, particularly in staples. Staples have been expensive for a while. And when you look at the staples category, you can be more choosy with it. So I've talked about this ETF before, PBJ, that's a food and beverage ETF, if you want to really hone in on certain parts of staples. Also, what you can do is, and I've talked about this on the show on a couple of these programs, is just look at a dividend ETF, because a lot of those dividend ETFs are going to have big allocations to utilities and to staples, and they do some of the screening for you. So a big reason why those sectors do well in these environments is because rates are falling. So you're not getting as much bang for your buck in a money market. You're not getting as much in a CD. You're not getting as much in treasuries over time, of course. I think right now rates are quite attractive still. But as they fall, investors are looking for income in other places. And if they're feeling pretty good about stocks in the economy, they want that capital appreciation opportunity as well. So dividend paying stocks do provide that. And utilities and staples, some of the highest dividend paying sectors. Energy does pretty well in there. Some healthcare names, but not entirely a dividend play there. So you can buy a dividend ETF. One of the ones I like is SPHD. There are some others. There's one that follows the Dividend Aristocrats Index, but make sure that you're looking at the yield that you're getting and the sector makeup inside it.
It's interesting, Dan. I will echo that, and then I'll add to it. You had Mr. Van Eck on the podcast, I want to say a few months ago, and the Van Eck Gold Miner ETF, that's the GDX. I mean, if you look at that, that's effectively now at 2-year highs. Newmont Mining, basically 15% of that. Agnico Eagle Mines, about 10%. Throw Barrick Gold. And that effectively is, I want to say, a third or so of this ETF. And you look at all those stocks, and even with Newmont now seemingly getting on its horse, I mean, gold miners are going to work in this environment without question. They're finally starting to participate on the back of a gold market that is at all-time highs. So there are things that are clearly working that make sense, Dan. There are also things that are working, to me at least, that don't make a whole lot of sense other than money flows into the stock market.
Well, I think that's the main point is money flows. I think that, what happened on Friday and what had been building up into that was kind of the all clear that the Fed was going to have your back as far as the rate cuts that everybody really wanted, at least for the stock market. And again, once that becomes a universal belief, that's where the risk is. I think in the market, we're going to have a VIX probably, on its way back towards, it's in the mid teens right now to the low teens. I want to make one other point about Van Eck. We had Matthew Siegel, who was also actually on that podcast guy with John Van Eck a couple months ago. He was on Fast Money last week. I was talking about crypto. And it's interesting because Liz just mentioned this, whether it is a store of value. That was easily one of the pillars, going back, 5 years or something when we were in that last sort of bull market. And yeah, it's had a bit of a rally, over the last, but it really is lagging gold for all intents and purposes. And you'd think that a lot of the demand aspects of just the ETF creations, I think there's probably dozens, if not, hundreds, that have been created over the last few months or so. But, it's still in a downtrend, Bitcoin. And, a lot of the stuff that you hear out of, this campaign, it seems like both sides are kind of moving more towards, kind of an open situation towards the creation of that. But I want to go to one other thing. Guy, were you surprised Friday by the KRE? This is the regional banks up 5%. So in one fell swoop, basically got back a couple weeks of losses. Same thing with the Russell. It's headed back towards those prior highs. So I'd really expect, the Russell to break out if this rally is going to have some legs, because you're going to want to see it broadening out. We started the show talking about, can NVIDIA keep the Gen AI trade going? And who knows? I don't know. You don't know. But you need to see a broadening out. And it can't just be for the crap. I see a bunch of crap that rallied on Friday and rallying into today. But to me, it needs to be a higher quality broadening out.
Well, I agree with that. And, the Russell, which had that obviously huge move to the upside a month or so ago, then the retracement back to the prior resistance level. Now it's back on its horse. And the carry, as you just mentioned, had a decent, not a decent day, had a very good day, obviously, on Friday. So the question I think you have to ask yourself, and Elizabeth is far more able to answer this than I am, but whether or not we're in early, mid, or late cycle. If you think we're in early cycle, which I don't, I want to be clear, then by all means, as you say, Dan, have at it in terms of not only the IWM, but the KRE specifically. However, I think if you think we're in late cycle, or at least mid to late cycle, I think you have to be somewhat cautious in terms of what you're doing in the Russell and the small and regional bank index, as one would, as history suggests, this is the exact wrong time to be foraying into those spaces.
Yeah, I would agree with that. Unless you're a swing trader and you're trying to just play this on very short-term swings, in which case the expectation, and not even expectation, now the concrete expectation that rates are going to be falling. I think probably what happened to the KRE is that there were still lingering fears, and there still are lingering fears about commercial real estate taking the whole thing down and all of the exposure that was there. So as rates come down, some of those fears come down with it. Also, as the yield curve continues to steepen, we're only at about 11 basis points inverted today. That is initially good for financials, because we've talked about this many, many times, especially some of those smaller financials that need that lending and deposit activity in order to make their books work. So a steepening yield curve does help financials in the near term. And I talked about this, I've been talking about this for the summer, that as we approach a rate cutting cycle, there are sectors that are going to do good initially. Those sectors are financials and real estate, because as rates come down, some of the demand goes back up, some of the default risk comes down, and you've got just more activity in that marketplace. And I think that that's a good thing, not to mention, as we're looking at stocks right now, obviously there's an expectation of a soft landing. So when you've got these really cyclical sectors, that's another tailwind that drives them. However, that doesn't mean that we have absolutely secured mid-cycle behavior, because to Guy's point, I still think that there is a lot out there that proves that we are in a very long late cycle, but we are still late cycle.
Wednesday, Dan, and I'm not looking to bury the lead here because NVIDIA obviously is important, but think about this for a second. You had a stock that traded an all time high, I believe it was on June 20th, of $140.76. On that huge sell off that we saw a few Mondays ago, we had a stock that traded down. I want to say it got down to $90 on the screws, but right around let's just call it $90. It subsequently has now rallied basically 50% off those lows, which is staggering when you think about it. This is a $3.2 trillion company. And once again, we're within sort of earshot of that prior all time high. So I guess the question I have to you, and Elizabeth is equipped to answer this as well, but how important is this earnings report? Not forget about NVIDIA for a second, but to the broader market.
Well, yeah, and I mean, first and foremost, to the ecosystem around it, right? So 40% of their sales comes from, Microsoft, Google, Amazon, and Meta, right? And so we've already gotten results out of them. We've already heard CapEx from them. If anything, their CapEx was kind of firm to stronger than folks expected. And one of the reasons why we saw some of these companies that have seen declining revenue growth that are still spending, that was one of the things I think a month ago that investors were kind of getting a little picky about, right? And I'll just go back to this. So we have an S&P that's up 18.5% on the year. We have a NASDAQ that's up 19%, and Microsoft's up 11.5% on the year. Google's up 18.5% on the year. Amazon's up 16.5% on the year. And so, Tesla is still down on the year, 11%. So think about that as far as the Mag 7. And I know we brought this up, but there has been money moving away from those. Obviously, NVIDIA's up 150% and Meta's up about 50%. Obviously, the two most important beneficiaries of all this Gen AI and the spending in and around it. So when I think about NVIDIA and I think about an implied move of 10%, Guy, you just said it's a $3.2 trillion market cap. The stock has obviously been a big mover on earnings. The last couple of quarters, I think on average, it's moved 10 or 11%. We're talking about $300 billion in market cap. That could happen, right? And so let's just think about this. If it is lower, okay, if it's 5% lower, if it's 10% lower, then the whole ecosystem, whether it's Micron, whether it's Dell, so the server guys, right? If it's all the hyperscalers, I mean, they're all going to go down. So I guess the point is, how do you think about that happening in an environment like this that we are just in? You have, a rate cutting cycle. You have a weak dollar, which is great for these multinationals, right? You have inflation on its way back, at least to the Fed's target, which they're suggesting. So in a lot of ways, this goes back to what we were saying. Maybe it's as good as it gets. At some point, NVIDIA, I had a great conversation with Dan Niles of Niles Investment Management last week on OK Computer. If you haven't listened, go listen to it, because we talked a lot about this. Dan, which is he's very bullish longer term about Gen AI. Most smart people I know are. It's just in the intermediate term, you know what I mean? The idea that we do have an investment bubble and it is likely to decelerate. So at some point, investors are going to say, this is as good as it gets, at least for a while. And I'm going to go to the sidelines here. And to your point, Guy, NVIDIA's just rallied 40% in a matter of weeks here. So to me, I do think it's going to be important, but I think it's more important for the ecosystem than it is for NVIDIA, because that's just one stock.
And real quick before Elizabeth opines, what's for me, me, the thing that I'm looking at, not necessarily EPS beat, the magnitude, all those different things. To me, if margins start to contract, um, and the guide is not as robust as we've seen in terms of just absolute numbers, in terms of the percentage gains, that's typically when things start to turn. So for me, at least, Dan, it comes down to margins. And in terms of what they're seeing, not necessarily, we probably know the guidance is going to be good, but is it good enough to continue to support? Forget about price to earnings for a second, but price to sales.
Well, that's really important. I think you just kind of touched on it. So right now for the out year, this would be fiscal 2026, right? Expectations for margins are probably 76%. That would be, very near a sort of peak margin. It's a mild deceleration, but the company already told you they're likely to see that. But for next year on their consensus estimates, it's trading about 33 and a half times earnings, but nearly 19 times sales. So what does that tell you? You know what I mean? Like, so to me, I just think that's a really interesting setup. If you do have a sales deceleration, but the margins come in, I think that earnings number is at risk, or at least the consensus is, Liz. So to me, are we placing too much emphasis on this one stock? Or, I mean, you understand where we're coming for. It's more about the 10 or 15 names that are associated with it that have also gained trillions of dollars in market cap because of this, what you want to call is a secular shift among tech names.
Yeah, well, I'll tell you something that I look at, the options market and what the market expects for the possible swings on the day of certain sets of news. And right now, what the market is expecting for NVIDIA's earnings is on par with what the market usually expects as far as volatility on the same day as a Fed meeting. So we've now got one stock with the same power as the entire Federal Reserve making a rate decision. And I think that that just goes to show how sensitive the entire market is to this. To all of the points about margins and earnings, the thing that I continue to think about, and this is not to say that I'm not negative on AI at all. In fact, I'm quite positive on it long term. But we pulled so much of it forward, and investors expected, I think, so much of it to come to fruition much sooner than it was going to be able to. I think the thing that NVIDIA is going to now be up against is that earnings growth has been so absolutely rock star that in order to keep up that pace of growth, which I mean, they've knocked the cover off the ball. In order to keep up that pace of growth, if investors have gotten used to that, it's going to be very difficult to stay on that same trajectory. I don't know how disappointed people will be if that growth slows down. Perhaps they will bake it in, perhaps they will be okay with it. But one of the other things that we know has happened with the rest of the Mag 7 is that as they've continued to announce more capex and as they've talked about spending, investors have started to punish them for that spending because they want to see where the profit is coming from. Where's the ROI now on that spending? So if those companies start to pull back on their spending because they're not being rewarded for it in the same way that they were before, that's where you start to worry about the sales in chip makers as well.
What's interesting, is was sitting here before you know it, August is going to be over, the summer's over, and we're into September. Things happen fast, Dan. And Apple targeting September 10th for the debut for the new iPhones, AirPods, watches, all of which excite me to no end. But Apple, a stock that again had a huge run after that event in June. Subsequent little bit of a sell-off, like we saw these other stocks on that pretty dramatic move a few Mondays ago. But here we are once again approaching all-time highs. I don't think this is a huge deal. Maybe the market does. Should I be more interested on the September 10th target date?
Well, it's interesting. We were talking about the June 10th Worldwide Developers Conference when they finally kind of announced their generative AI play. It's going to be on device. They talked about how it's only going to work on 15 Pros. That was last year's version. They're going to announce the 16 Pro on September 10th. And, that day when the news came out, we've talked about it. The stock closed down 1 or 2% or something, I think at like 192. The next day, it had a huge rally. I think it rallied like 5% in a straight line. This is the largest market cap company in the world when it rallied like that, and it kept on going. So when you think about just the fact that it round tripped almost that entire move, Guy, from June 10th to August 5th, and then we've kind of, rallied back here. I know we have a couple weeks on this one, so it'll be interesting to see what expectations turn into and where the stock is. But, their guidance for iPhone shipments, that's the main thing. That's why the stock rallied the way it did, because I think a lot of investors and analysts came out thinking, well, you finally have a proper reason to upgrade. They think that there's like a few 100 million, very old iPhones, 3 or 4 years, and the cycle, I think, for upgrades has been like 3 years, but they're talking this as a potential for a super cycle. So again, I'm sure we're gonna bat this one around for a couple weeks, and we'll take another look at it in the days leading up to it. But I think it's going to be a very specific thing to Apple. Anyway, Guy, really quickly, I wanted to hit this, and Liz, we'd love to get your take on enterprise software, but also on Wednesday afternoon, Salesforce reports after the close, and CrowdStrike. Now, CrowdStrike is a very specific sort of situation. The stock sold off 50% in what, a week or two after that big hack that they had. So that one is going to be very stock specific. But Guy, Salesforce is interesting to me. Flat on the year. We've been talking about the underperformance in enterprise software. We've been talking about how, enterprise budgets have probably moved away from some of these, licensing sort of models, and they've kind of made their focus in generative AI and testing some of those sorts of models and the like, and some of the kind of, I guess, applications for these, but they've really been left, you know what I mean, in the they've left in the dust here. Thoughts on these two names? They both have, big, at least they're talking up their generative AI strategies and the like. But again, is this something that could probably pick up this group, if you will? Adobe's still down on the year. There's a handful of names that still act particularly poorly.
What's fascinating about this, and I'm glad you brought it up. So, Salesforce, I believe, reports the same day NVIDIA does. And I think they're both after the bell. Don't at me if I'm wrong. So, what's fascinating about this is if you're bullish in Salesforce, and I'm sort of quasi ambivalent, although I will tell you, if you look at a chart for those technicians out there, we're effectively about to break through on the upside, a downtrend that's been in place since that sort of 315 level or so in March of this year. But with that said, if you want to play Salesforce from the long side, I think by definition, you almost have to hope for NVIDIA to miss. And that's going to sound somewhat counterintuitive, but I think what's happened here is a lot of the investment dollars have made their way out of these software names, Dan, and into obviously these AI names, specifically these semiconductor names. So if you were to see a rotation in technology, you very well could see it on the back of money coming out of the AI trade and maybe back in to some of these software names that have been left for dead.
I think that's fair. I think that's a very, very good point. And a lot of times I know we talk about this a lot. One of the pairs that I watch is semiconductors versus software. Why do you watch that? Because semiconductors tend to be more cyclical. So as things are expanding, a lot of companies are spending more in semis, spending more on innovation. Software tends to be a stickier revenue cycle. But if we do have a shift back into software, I think that says a lot about the economy as well. And depending on which software companies benefit from that, because what you tend to see is companies go back to, okay, we need to spend on the enterprise software that we cannot survive without. We have to have that, or we have to have cybersecurity, the things that a company needs to remain active and to remain a going concern. And then they stop spending on what would be considered discretionary items from an enterprise standpoint, which sometimes will be semiconductors, further innovation. Maybe they hit the pause button on that for a little while. So I think this is going to be a really interesting cycle to watch, not necessarily just these two names, but just semis versus software in general for the next few quarters.
Yeah, and before we get out of here, Dell on Thursday, I think it's interesting for obviously the same reasons. That stock obviously had a huge run from the fall into the spring, a subsequent sell-off. It's bounced a little bit, so we'll see if the Dell gets any love on the back of NVIDIA. But some really idiosyncratic things, and I don't think there are any tells whatsoever in terms of the consumer, Dan. But Lululemon, which has been a disaster now for quite some time, that to me, if there can be a modicum of good news, or maybe the bad news isn't as bad as the street is looking for, maybe you could get a relief rally in that. But if people try to then equate the health of the consumer with a potential bounce in Lululemon, I think that's a huge reach.
Yeah, you made the point. I mean, a lot of Lulu's problems are kind of Lulu specific as far as execution, and then competition, and then maybe a kind of weaker discretionary spending environment. And just one last thing, Guy, on the Dell. I'm glad you brought that up because, that was a stock that last quarter when it reported had a huge gap lower. Same thing for Salesforce. Same thing for Salesforce, huge gap lower. So it'll be interesting to see on misses and soft guidance as we get to the tag ends of S&P 500 earnings in an environment where it seems like, new highs in the S&P are a foregone conclusion, how investors react to bad news, right? And so that to me is something I'm keeping a very close eye on this week.
Lot to dissect this week. People obviously focused on Wednesday. It's more than just Wednesday. We have a bunch of data on Thursday, as well as, again, the Fed's preferred measure of inflation on Friday. So stay tuned, folks. I'll add this on top. The VIX is back down to 16, but I don't think that was a one-day event in the VIX a few Mondays ago. I think round two may be coming to a theater near you. So stay tuned. EYT, always a joy to see you. Dan Nathan, you as well. Tomorrow we'll be back with Market Call. Well, I believe the great Carter Braxton Worth will be joining us.
Yeah, and Liz on Wednesday, and I'm gonna have a great conversation on OK Computer that'll drop Wednesday morning with Gene Munster of Deepwater, and we're gonna do a big NVIDIA preview. So check that one out, Liz. It's been great to talk to you early on a Monday morning. Guy Adami, I'll see you on CNBC's Fast Money this afternoon. Thanks everybody for being here.